Hello, everybody. Welcome back to Financial Options with Thumper. And today we're going to talk about margin. And since we're talking about margin, I think it's important to remind you at the start of the video, I'm not a financial advisor. This video is for entertainment purposes only. And it's just going to showcase my understanding of margin, which may or may not be the correct thing. Make sure if you are going to switch to a margin account, do your own due diligence, contact your financial advisor when making financial decisions, all that. Now, with that said, talk about margin. We've all heard about horror stories of people blowing up their accounts because they've been using margin. And I gotta tell you, like, margin gets a bad rep like that. Margin is actually a pretty good tool to use. I like to think of it like a chainsaw. If you use it properly, like, you can get a lot of work done. If you use it irresponsibly and don't manage the risk when using it, like, you could lose a limb pretty quickly. Uh, a trader won't blow up their account because it's a margin account. They'll typically blow up their account because of their risk management and not sticking to their disciplines. Let me tell you, I can blow up a cash account just as I can with a margin account. So don't let that margin rep deter you from investigating if margins are good for you. I'm going to start off by telling you some of the benefits. And the first one is you don't have to wait for your cash to settle. Usually when you make a trade, you have to wait a couple of days before that cash becomes available for you to trade again. And by using this, you also get to pretty much ignore two rules that just makes it easier to trade in general, not having to worry about these things. Just simplify the game, make it easier. Another benefit is that you can use, obviously with margin, you can create leverage, and that's how you can juice your returns massively if used properly. So I said that one of the things that's great about using a margin account is you don't have to worry about like two rules when it comes to trading. And one of those is the good faith violations. And this is essentially when you buy a security and sell it before the initial purchase is paid in full with settled funds. And I'm not going to go over it too much here because I'm not too familiar with it since I've been using a margin account. But essentially, if you do this 3 times in a 12-month period, your account will get a 90 days restriction. If you continue doing it, your brokerage will probably ban your account. And another one is the free riding violations. Similar thing. This is when you are buying stock when you don't have the money to secure it, and then selling it to cover the cost of that purchase. And one of these violations in a 12-month period will result in a 90-day restriction, and then more than one will typically result in a ban of your account and your brokerage. But check with your brokers to see what those rules are. Or you can switch to a margin account and not worry about either of these things. So that's why I love the margin account. It simplifies trading. You don't have to use margin in order for it to become a benefit for you. If you like this content, be sure to like, share, and subscribe. So just because you have a margin account does not mean you're actually using margin. If you buy on margin, that's when you're borrowing money and you have to pay interest because you're borrowing that money. But when you're selling options, you're not actually borrowing that money. You're just setting aside cash to secure the positions if you need to buy those positions. So what I'm trying to say here is if you're just selling options, you're not actually using the margin, so you don't have to worry about paying margin interest yet. Only if you get assigned those shares and you don't have enough cash to cover it, will you start borrowing on margin and have to worry about margin interest. And you can't buy options on margin. You have to have the cash on hand to secure that position. So if you go to buy a long call because you're setting up a poor man's covered call, you're going to need cash in your account to buy that position. And when you put that on, you won't see your margin maintenance increase at all because it's secured by the cash. When you're making a trade, your broker will assess a requirement. This is typically around 10 to 20% of that trade. This is the amount of money needed to secure the position, and it comes out from your free cash. Like, they don't take the cash away from your account. They kind of just partition it aside, like, this secures this position. During the contract's duration, you will see the margin requirement fluctuate higher and lower depending on a few factors, such as price movement. Your margin maintenance is not a static number. The broker is going to reassess your positions, and it'll adjust the margin requirement accordingly. This is because the broker wants to make sure that they don't get messed up when you blow your account if you do that, if you're making risky trades. As we enter like more volatile periods, you'll see margin expansion requirements. So something that took like $2,000 to secure a position in might expand to 4,000 if volatility increases, or if the price is going against you, and the chances of it being in the money increase. Or you see it expand when it comes closer to expiration. Margin maintenance. These are some pictures from Interactive Brokers, and on the left here, you can see on my quick overview, I have a thing called maintenance. That's how much cash I need to have in the account to secure all my positions in this account. And then above it is your net liquidity. This is what your account is worth if you were to close all your positions. And essentially, you just gotta make sure that your maintenance stays below your net liquidity. If you don't, you end up getting a margin call. And some brokers, like Interactive Broker, would just go in and liquidate positions to satisfy that call. But we're going to do that in a second. If you're looking at this view, is the account window view. You can see there's also a thing called initial margin. This is the amount of cash that you need to have in your account in order to be able to open new positions. It's just another safeguard that the brokers have in to protect themselves, make sure you're not over leveraging. Down here again, current maintenance margin. And one thing I like to do is look at my margin ratio, and that's simply your maintenance divided by your net liquidity. It's common for people to say keep it under 50%. I tend to trade between 35 and 45%. I'm actually now aiming more for like the 30 to 40%. Currently, I'm at 18% right now. It's just I've been putting on a lot of new stuff recently. If your margin maintenance exceeds your net liquidity, you're getting a margin call. And no, this isn't them calling you on the phone that you can just ignore. Like they'll send you an email or a message through the brokerage and tell you that you need to deposit more money to secure your positions, or they're going to liquidate your stuff. Check with your broker to see what exactly or how they handle a margin call. I know Interactive Brokers, they'll send you a message, and then in 5 minutes they'll start liquidating positions to cover it, because that's just what they do. Every broker's going to be different how they handle that. And another thing to know is how long it takes for a deposit to hit your account. Like Interactive Brokers, it'll take you a week for your money to show up. So if you get a margin call, starting a deposit to satisfy that is not going to work, because it'll take a week for that to come in. Another good thing about margin is the leverage that you can do with it. You use a fraction of the buying power it would take to secure a position. So in this example, I'm looking at selling a Apple 115 put. If I was doing this with cash, I would need $11,500 to do this. But using margin, I can look at the initial margin and margin maintenance and see it only takes $1,427 to secure this position. If you haven't seen like this Interactive Brokers snapshot before, this is what you see before you put in a trade. And over here, you see how much I would be receiving for this position, $58. Okay. I'm kind of getting a little off track there. Going back to margin specifically, what's great about this is since I'm only using 1427, I can still put on more positions with this small account if I only had 11,500. And what I would do is pick different sectors, put on other plays, maybe put on 4 or 5 positions, maybe be at 6,000 margin maintenance, so about 50% here. And instead of having one position, if it goes bad, I'm losing stuff, I now have multiple positions where there might be other winners that will pay for this loser. So getting that leverage to be able to spread out your plays is pretty nice. And that's not to mention that after you put on this trade, if you close it, you don't have to worry about the settlement period, so you can go on and start trading that same, like the following minute. Whereas if you're not using a margin account, you have to wait for all that cash to settle, and you're losing 2 or 3 trading days. Some tips: don't over leverage. Find what you're comfortable with and stick with it. If you search YouTube videos, you'll find it's kindly recommended to stay below 50%. And what I'm talking about is that margin maintenance divided by your net liquidity. I usually aim for 30 to 40%, or I guess I put 35 on the slide. And even I've seen how stuff can move against you pretty quickly if you're over leveraged. At the start of May here, like in 2 weeks, I saw my account drop drastically because my positions were going against me, had margin expansion, had explosive positions to Make sure I didn't get a margin call. I was nowhere near it. I was managing it beforehand, but it's just stuff to think about. If you're sitting at 50%, margin's going to expand pretty quickly, and you get to close a lot more positions than if you're sitting at 30%. You have more wiggle room. You might be able to wait out a small pullback. So trade small. If you're starting out new, maybe when you don't leverage up yet, start you're just securing positions as though you don't have margin, just to get used to how the mechanics work. Margin expansion, something to be aware of. Say you had an account with 100,000 and your margin maintenance was 50K. Your ratio right now is 50%. But if your positions drop 10%, the brokerage is going to reassess those positions. They're going to increase that margin maintenance. In this scenario, let's just say they increase it by 20K. So you think your ratio will be 70%, right? Wrong. Because you dropped 10%, your net liquidity is down to 90%. Instead of being at 70%, now you're at 77%. And another 5% dip, you might be getting a margin call. So it expands quickly. So keep it low. Stick to 30%, or don't go over 50% if you can avoid it. Some things to know about margin expansion is there are ways to try to manage that. And the first thing to do is close positions. What I like to do if I feel like my margin maintenance is becoming an issue due to expansion, I'll look at some winners, maybe take those off the table to reduce my margin maintenance. Another thing I'll do is I'll look at positions that have a large margin requirement. Even if I think those are going to be huge winners, taking off that trade to free up that margin maintenance might be worth it, giving up a profitable trade just to make sure I don't get a margin call. And another thing you can do is roll out positions further in time. As positions come close to expiration, typically the margin requirement goes up because if there's a quick swing in the price, it's just more risky as a result. So by rolling a contract out further in time, you can reduce the margin maintenance and relieve some pressure that way. Another thing you can do is turn some questionable positions into spreads. You're kind of locking in some losses if you're doing that, but you see your margin maintenance come down drastically if you turn it into a spread because you're defining your max loss in that position. And obviously the other option you can do is deposit more cash. Interactive brokers is not really a good strategy because it takes a week to get there, but other brokerages, that might be a good thing. So margin is a really good tool that you can use to really juice your returns and get some nice income going on a smaller portfolio. But it's also can act as an accelerator for losses too. So just be careful when you're using it. Find what works for you. Slowly use the leverage. Don't jump all in. Just because you have all that buying power available to you doesn't mean you should be using it all. Leave room for margin expansion. I'd even say stay under 20% until after you've experienced margin expansion so you can see exactly how fast it goes up, because it does go up pretty quick. And with all that said, I hope you enjoyed this video. Thumbs up if you did, and good luck trading next week, guys.
I'm not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.